Hello investors, welcome back to Invest Money UAE. In last financial year, that is from 1st April 23 to 30th March 24, Nifty has given 28% of profit and Nifty small cap and Nifty mid cap has given 61% and 35% profit respectively. And if you check from the starting of the year, Nifty 50 has gone up by 15%. So profit, profit, profit. Who doesn't like making profit on their investment? But as Benjamin Franklin said, nothing is certain except death and taxes. So where there are profits, there are taxes as well. But is there any way to reduce or eliminate the taxes? Absolutely. You can reduce your taxes to zero. You heard it right. Today we will discuss revised capital gain taxes on equity related assets or funds. We will see in Excel how much tax you have to pay in different scenario if you have invested in share market and what will be the actual CAGR or IRR after deducting latest tax rates. And at last we will talk about less known and less understood way to save tax, that is tax gain harvesting. So do watch this video till the end so that you can understand this tax saving strategy clearly. First, let's take a quick look to revised capital gains taxes on equity related assets. Capital gains taxes are of two types, long term and short term. lTCG and STCG are most used terms for them respectively. lTCG is applicable if you are holding any listed securities like shares, mutual fund, REITs for more than 12 months, else STCG will apply. Before the budget day, that is 23rd July 2024, if you sold an equity fund within 12 months of buying it, you paid a short-term capital gain tax of 15%. If you sold it after 12 months, you paid a long-term capital gains tax of 10% on gains exceeding 1 lakh. While these holding periods haven't changed, the tax rates have increased. Now, short-term capital gains are taxed at 20% instead of 15%, and long-term capital gains are taxed at 12.5% instead of 10%. However, long-term capital gains up to 1.25 lakhs in a financial year are still exempt from tax. The 12.5% tax applies to gains above this limit. In summary, taxes on short-term and long-term capital gains have increased, which is a bad news for investors. The increase in exemption limit may provide some relief, but it remains to be seen how much it will ease the pain for the investors. Let's understand this with the help of examples. Imagine you invest 1,20,000 in an equity fund or holding a portfolio that is expecting 15% return per year and plan to keep this investment for 5 years. For simplicity, let's assume expense ratio as 0 because it's different for different funds but tax is same. Later, if you wish to include expense ratio also, you can do that. I will share the link of this Excel in description. Now, by the end of the 5th year, your investment would have grown to 9.3 lakhs, giving you a gain of 3.3 lakhs. After subtracting 1.25 lakhs exemption, the remaining 2.05 lakhs would be subject to tax, which would cost you roughly 25,681 at 12.5% lTCG rate. And total amount received after tax will be around 9.04 lakhs, which means actual CAGR is not 15%, it's 14.02%. And if you increase the period to 10 years, your total investment will grow to 28 lakhs. Tax payable in this case will be 1.84 lakhs and CAGR further reduced to 13.81%. Let's change the scenario. If you remain invested for only 5 years but have increased the amount to 6 lakhs per year, then what? Total investment will grow to 46.5 lakh and total tax will be approximately 1.9 lakhs. CAGR in this case will come as 13.53%. Now what we can do to save our taxes? Let's take a different approach now. Since gains up to 1.25 lakh in financial year are tax free, you can sell your fund after 1 year, lock in the gains which would be under 1.25 lakh and then reinvest the money back in the same fund. This process reset the cost of your investment to the new with higher amount. In our initial example of 1.2 lakh investment for 5 years, After the first year, your 1.20 lakh grow to 1.38 lakhs. You sell the fund, book the 18,000 gain, and reinvest this 1.38 lakhs after adding more 1.2 lakhs for second year. So total 2.58 lakhs invested for second year, which will grow to 2.96 lakhs. You again sell the fund and book the profit of 38,000 rupees. A second year profit is also not more than 1.25 lakh, then you are not liable to pay any tax. By repeating this every year, you can avoid paying taxes until your profits exceed 1.25 lakhs in a single year. See, till 5 years you have not paid single penny as tax. And for 10 years, which is our second scenario, even though you will start paying taxes from 6th year as gains go beyond 1.25 lakh, your total tax bill would be around 78,000, much less than 1.84 lakhs you would have paid if you sold everything at the end of the 10th year. This strategy, called tax harvesting or tax gain harvesting, can significantly reduce your taxes on long term capital gains. Keep in mind that this method only works for long term gains, not the short term ones, because it takes advantage of the 1.25 lakh tax exemption limit. Let's also quickly see for third scenario where 6 lakhs was invested for 5 years. In this case, from second year your profit exceeds 1.25 lakhs, hence you will pay tax of 8,562 rupees. But when you check for total tax paid in 5 years, it's 1,30,000. Now you will ask, most of the people invest in equity funds through SIPs. In case of SIPs, tax harvesting can still work for you. You will need to focus on SIP installments that have completed at least 1 year. For example, in the 13th month, first SIP installment would be eligible for tax harvesting if it has made a profit. The first in, first out FIFO rule applies here, meaning the SIP you invested first is the first to be redeemed. However, make sure the SIP is in profit, otherwise, you could end up with a loss instead of tax benefit. Some people worry that tax harvesting might interfere with the compounding of their investment. The good news is that it doesn't, as long as you reinvest the money back into the fund. Tax harvesting simply resets your investment cost price and turns unrealized gains into realized gains, so compounding continues as normal. That's a quick look at tax harvesting, also known as tax gain harvesting. In a future discussion, we will explore its counterpart, tax loss harvesting. It sounds interesting, right? But while using tax harvesting, you should keep few things in mind. First thing, it's important to calculate your capital gains accurately. This will help you decide how much tax harvesting is required for you. You can get your capital gains statement from platforms like CAMS or KFintech, or from fund houses where you are invested in, or else you can import your portfolio with us. We will remind you and help you in tax gain harvesting. Another important point is that this 1.25 lakh tax exemption limit on lTCG is applicable for all equity investment. That means it covers your stocks and mutual fund both. So if you have invested in both, then consider both of them. Next, selling funds and stocks also come with cost like exit load or brokerage fees. So this can eat up your benefits of tax harvesting. Also, if your fund has any kind of restriction, like there are funds which just take SIP, not the lump sum, or ELSS, where you cannot sell the fund before 3 years lock-in period ends. Final words, just because tax saving strategies like tax gain harvesting exist doesn't mean you have to use it. If you find tax harvesting is not for you, then it's completely okay. Ultimate goal should be to stay in control of your portfolio and focus on growing wealth. Wealth should give you freedom, not keep you constantly stressed. Thank you, friends. If you found this video helpful, then please share it with your family and friends. Don't forget to hit the like and subscribe button. If you want to explore and download that Excel shown in this video, then link is in the description. Thank you. Happy investing.